The underlying context to asset allocation is that all of us want to achieve this goal, this dream of consistently buying low and selling high. Right? This is what we always want to do. We want to buy a stock that is 100 and sell when it's 1,000. We want to buy a mutual fund when the NAV is low and then sell when the NAV is high. This is what we always want to do. The key problem is knowing when the price is low and when the price is high. And the solution to this dilemma is really asset allocation. What is asset allocation? Asset allocation is simply put, having the right balance in your portfolio between safety and growth. There's a adequate part of the portfolio that is growing at a good pace so that it can beat inflation. There's an adequate part of the portfolio that is safe so that in case of situations like this, not all of your portfolio is affected. And that balance between safety and growth is asset allocation. So asset allocation is having a right balance between safety and growth. So FDs represent safety and shares represent growth in this simplistic analysis. How do you do asset allocation? This is what we as financial planners do daily. We look at the portfolio balance, and if there are no, take whatever is excess and redeploy it towards the other side, and vice versa. So I have a small example that comes up which will make it very clear. But in case people have new flows coming in, we direct that to whichever is less. So suppose you have a portfolio in which your target is 50-50, but fixed deposits are 60 and shares are 40. In this situation, you'd be directing more of your new flows into shares. If it is vice versa, which is shares are 60 and FDs are 40, whereas you should be at 50-50, you'd be building up additional safety in your portfolio. So here's a little example of what happens. Let us say that somebody had 20 lakhs to invest and we were in July. And your overall objective was 50% safety and 50% growth, or 50% equity and 50% debt. What you would do then is to take 10 lakhs and put it into equities and 10 lakhs and put it into debt, because then you have half and half. Let us say between July and October, there was a bull market in which 10 lakhs became worth 15.5 lakhs. And debt, of course, continued to grow slowly and it became worth 10.5 lakhs. So at this case, your total portfolio is now worth 26 lakhs. You want to reach the same balance of half and half, which means that each of them have to be 13 lakhs. So what you would do is take 2.5 lakhs out of equity and move it into debt so that you have 13 lakhs each. So again, you're back to 50-50. Now, let us say between October and Jan, equities went through a sharp correction where 13 lakhs became worth only 10.5 lakhs. Debt continued to grow, so debt became 13.5 lakhs. So at this point, your total portfolio is worth 24 lakhs. You want to come back into balance. So you want 12 lakhs of equity and 12 lakhs of debt. So you move 1.5 lakhs from safety into growth. As a result, you have a properly balanced portfolio. This is it. Mechanically, this is what we want to do. But what is interesting in this process of what we've done is to look at what our transactions were, right? At a point where the markets ran up, where the markets went high, what did we do with equities, right? When the markets went high, we sold equities and moved that to debt. So we sold high. Similarly, when the markets corrected, when the markets fell, when it went low, we ended up buying equities. So we bought low. So overall, a slightly nebulous but very desirable goal of buy low, sell high, we were able to achieve through this process only because we did a couple of things. One, we set out a goal, and the goal was having a portfolio that was 50-50. And the second thing that we did was we clearly established a certain discipline that we would look at our portfolio every 3 months and take corrective action only 3 months, but definitely every 3 months. By bringing in a target and bringing in a level of discipline, we were able to achieve something that otherwise could be quite nebulous. This is the power of asset allocation. And this is why it's so important in your investment behavior. And hopefully, as soon as I've said this, now it is very clear what we should be doing in a situation where the markets have fallen by half. If your asset allocation permits you, as in after the fall, you are not at your target asset allocation, your growth portfolio is less than where it should be, yes, it is a buying opportunity and it is worth moving into equities at this point. On the other hand, suppose your portfolio is significantly overweight equities and even after this correction, you still have too much equities, I would say be that calm person, do nothing at this point, let us see this through, because, this too shall pass. And, we're a 15-year-old company. We've been doing this for the past 15 years. And over this time, we've found the power of asset allocation to be very, very strong. And it's at the core of, how we help our clients manage their money. I wanted to shift gears a little bit and talk to you about, the value of having or working with an advisor. We've really been fortunate in working with a number of customers. Some of you are on the call today. You kind of know what I'm talking about in terms of the value of advice. This is apparently something that Carl Richards, who is a famous, economist and investment advisor, drew up on a napkin on a sheet of at a restaurant in terms of the behavior gap. And this is actually quite a powerful thought, but very simply put, what this means is that if you had a stock and the stock went from, let's say, 100 to 400, or if you had a mutual fund that grew by 17 or 18% every year for the past 10 years, that is the investment return. But if you take all the people who had invested in that instrument, whether it be the stock or the mutual fund, very few of them made the return that the instrument made. On average, the investor's return was less. The instrument may have generated and delivered a return of, say, 18% a year, but the investor's return was only 13 or 14 or 10. And the reason there is that gap is because of the behavior of investors. So let's just understand that a little bit better using a slightly historical context here. Everybody, according to this slide here, says everybody wants to buy low and sell high. But if you look at how people have behaved in the past, and this is a slightly dated example, but it's from the period of 10 years from FY03 to FY12. And if you look at, how the behavior of investors was over this period, what would buy low and sell high mean? Essentially, knowing what is low and what is high is usually evaluated using the price earnings ratio or the PE ratio. So the index, let me come back. The index PE across these years followed this pattern: 10, 11, 11, 13, 15, 20, 15, 17, 17, and 14, right? So if I wanted to decide that I wanted to buy at low and sell at high, what I would do is I would have put in a lot of money into the markets when the markets were at 10, and really taken a lot of money out of the markets when it was at 20. But let us see what actually happened. When the markets were at 10 or low PEs, here only 118 crores was invested, here only 504 crores was invested. At the highest PE, 52,000 crores was invested. So although we think that we normally buy low and sell high, most investors don't behave like that. Most investors tend to be guided more by their emotions. When there's a lot of euphoria going, there's a level of greed that creeps in, and we think that the party will continue forever. And even though the PE is 20, we think it's going to continue to 25 and 30. And same thing on the opposite side. We think that when there is tragedy on the streets, PE ratios are at 10, we think it can go to 8, 5, and 2. Therefore, we exit and we don't put in money. So what is the value of advice here? The advisor will use a tool like asset allocation to help you know when the prices are high, know when equity is overweight in your portfolio, and when it is underweight in your portfolio, and really guide you to stay close to your target. And as a result, you are not likely to be like the typical investor. You're likely to be a smart investor who sees this as a time in which to exit and these as times in which to enter. Thank you so much for taking the time. For those of you for whom PeakAlpha is new, we'd love to engage with you and see if there's a good fit between PeakAlpha and what we do and what you might be looking for. And if we meet your requirements, then we'd love to welcome you to the PeakAlpha family as well.